Markets will be watching for a key inflation gauge later this morning when the personal income data is released. Our next guest says that he's been struck by how much investor sentiment has shifted from March to June, driven in large part by that 10-year yield. Joining us right now is Jim Paulsen. He is chief investment strategist for the Leuthold Group. Jim, you put out a really interesting note this week where you pointed out everybody was convinced that we were going to see much higher yields. We were at 1.75% a few months ago. We were convinced that we were going to look at 2% and beyond very quickly. And we were all wrong. Right. The yields obviously have pushed back down, and now we're at 1.4% and change. Everybody's convinced the yields are never going back up. You think we could be on the cusp of another everybody being wrong moment. Why?
I do wonder about that, Becky. I mean, you remember the first quarter with yields surging higher and break-even rates, the bond market's inflation expectation was surging higher, and commodity prices were surging higher, and there was just a sense that the Fed was becoming way behind the curve, and that inflation we all knew was going to get a lot worse soon. And as you said, people felt when the bond market closed at about 1.75 on the 10-year at the end of March that yields would very soon blow through 2%. And so, you know, you think of the recommendations at that point, and people said, well, you better dump those tech stocks, you better dump growth, buy value, buy financials, buy cyclicals going forward. What happened? Well, the yields peaked at 175, and rather than going up, they came all the way down to low 140s last week during the Fed meeting. The yield curve, rather than continuing to steepen, actually flattened. By the end of the quarter, break-even rates rolled over, commodity prices rolled over. And here we are, sitting now at 145, 150. And the recommendations are kind of, well, maybe the Fed is right. Maybe yields will be lower for longer. Maybe inflation is only transitory. And so, gosh sakes, you ought to buy those tech stocks, and growth's going to have a renaissance, and dump cyclicals and value and small caps. And I just wonder if the same overzealous sentiment today, the opposite of where we were in March, is more a signal that we might be close to the low in yields, and you might want to actually go back to cyclicals and smalls again, and be careful of being too overweighted into this new rally, so to speak, into growth, into tech right now.
Jim, what makes you think that, other than the wisdom or lack of wisdom of crowds?
Well, I think that's a big piece of it. But if you think about it too, Becky, what is different, in March, everyone thought yields were going to blow through 2%. I don't think today most people think they're going to blow through, 1% or go down to below 1.25. What they think is they're just going to stay low. And if you think about that, growth is still, we might be in a 10% real GDP quarter. We could grow 10% next quarter. We might pass another fiscal package. We're going to keep growth very strong. And so whatever inflation does, that looks strong too. But whatever that does, real growth is going to stay strong. It seems to me it's much more likely before the year ends that rates go back up than they go down. Just when you look at the fundamentals that are happening right now. And from a 150 yield, it seems a lot more likely we might still see 2% by the end of the year. And if we do, boy, there's just such strong correlation between where the 10-year goes and what happens to growth, what happens to value, what happens to smalls, what happens to cyclicals. They're just directly tied to the movement of that 10-year. And I think if you look at the rest of this year, it's a much better bet to bet yields go up and to bet on cyclicals, smalls, international markets, value, than it is the other way around.
Shepard Smith here. Thanks for watching CNBC on YouTube.